U.S. stocks kicked off the trading week with record highs, boosted by merger mania on Wall Street. U.S. brokerage Charles Schwab is buying rival TD Ameritrade for $26 billion. The merger will create a company with more than $5 trillion in assets. Jeweler Tiffany & Co. said yes to French luxury giant Lvmh's takeover proposal of $16.2 billion. It's the largest ever deal in the luxury sector, and according to Bloomberg, will more than double Lvmh's market share in jewelry to 18.4%. Swiss-based drug maker Novartis is making a $9.7 billion bet on US biotech firm The Medicines Company. Another Swiss firm wanting a piece of the US market is online ticket marketplace Viagogo. The firm is buying eBay's StubHub for $4 billion for its first foray into North America. Analysts say global mergers and acquisitions are being driven by fading recession fears, as well as central banks lowering interest rates and making lending cheaper. Optimism over a deal between US and China to end a trade war is also improving business sentiment. The $12 billion merger of media companies CBS and Viacom is set to close next week. Investors are also keeping an eye on talks between Fiat Chrysler and Peugeot. A deal between the two would create a $50 billion transatlantic auto giant.
It's very important because the new group will be the fourth in the world. So the two previous companies will increase their competitiveness.
But one multi-billion-dollar takeover bid is turning into a hostile battle. Tech giant HP has again rejected Xerox's $33 billion acquisition offer, saying it's significantly undervalued. Both companies are struggling to keep their printing businesses relevant as digital documents become the norm. Analysts say a merger could help save costs, but they would still need a strategy to curb dwindling earnings.
Well, for more on the recent merger mania, let's speak with Santosh Rao in New York. He's the head of research at Manhattan Venture Partners. Good to have you back on the program as always, Santosh. So we've got Charles Schwab buying TD Ameritrade, LVMH acquiring Tiffany, Viagogo merging with StubHub. Just a few of the deals that have been announced over the last 24 hours. What do you think is behind this buyout frenzy, do you think?
Sure. So the number of trends underlying this whole thing. In the three cases that you mentioned, the Schwab deal really reflects the lack of the disintermediation and the zero commissions where the market was heading to. TD Ameritrade's main source of revenue was that. So I think it was a good strategic move on Schwab's part to kind of bring it down to zero and then scoop TD Ameritrade up at a low price because their value went down after it went to zero commissions. And similarly with the LVMH and other stuff, there is a trend towards online commerce. I mean, everything you're seeing trend, the secular trend that we've been watching is kind of playing into these markets. And because of the macro environment, the global environment, everything is picking up. This is a perfect time to sell non-strategic assets and make strategic acquisitions. So I think this is a perfect time the setup is right for M&A activity.
Okay, so tell us more about that macro environment that you're talking about, because for many months, as you're aware, we've been covering some of the headwinds that I guess have hit corporate sentiment, including the ongoing US-China trade war. Do those concerns still exist? I mean, obviously something like the trade war is still ongoing. Why are boardrooms feeling more confident now?
Yes, yeah, I think definitely the winds are blowing away. They're blowing to things are getting more favorable. We saw the Fed chairman's comments yesterday saying that there is no reason why the economic strength, the bull market, the 11-year bull market should stop now. He expects it to continue. Then you're seeing the other thing, the trade wars, while still turbulent up and down because of the rhetoric, it's moving in the right direction. And pretty soon, looks like we'll have at least the phase one deal, and even the Chinese won the deal. So I think looks like things are moving towards the right direction. correction. Europe is coming up. The interest rates are still low. So all that stuff, I think that was the big problem. In the rest of the world was slowing down. US was strong. Then you had the Brexit fears. That also is coming down. So all these other factors were kind of playing into this whole thing. All those clouds seem to be clearing out at this point, and the road seems clear for a nice runway ahead for the economy.
Interesting. Now, investors were also preoccupied with the possibility of a recession in the United States, where you are. That, of course, was driven by the yield curve inversion on the bond markets. Does that mean a US recession, according to investors, is perhaps less likely now?
No, I don't think a recession is on the card. I mean, I'm not an economist per se, but just listening to them and reading from what the major economists are saying, it's not until 2021-22 that we'll see any recession, if there is any. A recession doesn't automatically have to come. I mean, the underlying trends have to deteriorate, but at this point, I think things are fine. The Fed is being very cooperative and very supportive of the whole market, the whole economy. So I think there are a lot of things working, unlike in the past where the economy just went on its own. But now you have the Fed driving this whole thing, controlling this thing. So I think the risks are much more less now, and there is growth ahead for a lot of companies. The emerging markets are just coming up. There's a lot of pent-up demand for so many things right now, and hopefully there will be some kind of rationality and peace going ahead, and we don't have this macro tailwind, headwinds everywhere kind of disrupting the flow. Looks like at this point, from today's vantage point, the economy seems to be fine, the factors seem to be fine, and everything is supportive towards a good run ahead.
Okay, let's see how long that positive sentiment lasts. Santosh Rao, thank you for your time as always.